Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Despite the recovery from the Chinese tariff snafu that we saw in the grain markets earlier in this week and the prior week, we're noticing that May corn continues to struggle near that key 389.25 number that we spoke about previously, that this market needed to close above this week if we're going to see the probability of continued higher prices. Early in the week, we started higher, but we can see where the market has since been declining, and despite a small bounce on Thursday, the market once again on Friday is giving up some of its gains. We're leaning right up against our 1x1 angle now, and we're also walking into a potential time factor. So if this market continues to simply crawl sideways going into our next time factor, we anticipate that the market can either move up or down from that point. But given the fact that we are now at a key time factor where we were anticipating a potential top, our predisposition is that corn could very well be headed lower. Some key overhead levels that we are seeing are as follows. We've discussed in great detail in the past about the importance of the 180-degree mark. We can see where the market tested this level near March 13th, once again later in the month, and then one more time this past week. The market has tested this level on several occasions, and this 180-degree price factor continues to be very strong resistance, and this is going to be the key level for this May contract to get through if it is to make it somewhere in the neighborhood of $4 before the end of the month. Our resistance levels for the December contract at 417 continues to hold very well, and we can see in this pattern, which is a little bit different from the other pattern that we saw in the May contract, that we have a very clear higher high situation as opposed to a lower high that we are seeing from the May contract. Additionally, our time factor coming in near the April 8th timeline is now very much in play. The market's made a top at this area here, and in fact, we can notice that the momentum is also dying on as far as the oscillator is concerned for the December contract. Because of the movement that we're seeing now, if this market early next week is able to break down below this 1x1 level, which is near 408 or 407, we'd be looking for continued weakness in corn if this level breaks next week. Additionally, one standard deviation above our point of control sits at 415. And 415, just like our 180-degree factor for the May contract, can often operate as very good resistance when the market tests that level. We can see below that the market at the point of control found a very key area here despite having gone through it. The point of control number at 405 is where the market did close during the tariff fiasco. Since then, the market found good support at that level, moved up to the next point of control level, and now we can see that that point of control area was resistance and the market looks to be moving back down. The last piece that we also want to bring to your attention is that the market is also at volatility-based resistance, and when markets reach those zones, we can often see somewhere in the neighborhood of 5 to 8 trading bars where the market will either change its course or at the very least move sideways until it's able to redirect and find its way back up again if that is the direction it's looking to go. Alternatively, we can see that the market could very well be on its way back down, and volatility-based support below sits in the neighborhood of 392 to 387.5. This could very well be a near-term target for this December contract if it's not able to get through this 415 to 420 number. July soybean also reached a very critical level, coming up to its 360-degree mark at 1079.5, as well as the point of control number at 1071. In doing so, the market now has found a bit of resistance, and we can see in Friday's trading that the market looks to be a bit softer, and its inability to close above this 1071 number puts us at jeopardy of being able to reach upside targets of 1100 that we have had for this market for some time. Next week is going to be critical for the July contract, and upon being able to get back above the 1080 number, that would give us the potential to reach out to that 1100 number target that we've been looking for. But its inability to do so next week suggests that the market may have found its run and that we can see a corrective move coming in for soybean. Resistance for the soybean contract is also clashing with our 1x1 timing angle, and we can also see now that the market's coming into our time factor as well. So with it coming into a potential time factor in conjunction with resistance begins to suggest that beans may in fact have run its course, and so it's going to be very critical to see the way in which it responds early next week. The critical number for the November beans contract was at 1052.25. And we can see the way in which this market has been responding to this level upon reaching it has been very strong resistance. We spoke about how it was very important for this market to close above 1052.25 this week. It appears that it's not going to be able to do that. So now we'll be looking to early next week to see if this market's able to regain this level. If it is not, we anticipate once again that soybean may have run its course and we'd be looking for potential downside support instead. If it is able to rise above resistance at the 1052 number, then we'd be looking for an upside target that ranges somewhere in the neighborhood of 1070 to 1080. July wheat has performed perfectly in conjunction with our time cycle projections, with the collection of support that we did find up against the 460 number that the market had been seeing over the last couple of weeks. After this consolidation period, the market was able to break back above the key 484.5 number, and in doing so, made a very clean advance straight up to the next key level, sitting at 508. Upon doing so, we can see over the last couple of days that we've seen some profit taking, but it was important to see the way in which this accumulation phase did occur perfectly in conjunction with our cycles. Right in the middle of the move, we did see our time factor come in for the significant low. The market continued, and we saw a mirror move operation on either side of these lows. It was able to do on the upside what had happened on the previous downswing. Upon finding resistance here near 508, 509, the market could very well find some support near this 484.5 number. And if it does find support here going into next week, we would be looking then for the market to make one more potential nice run to the upside, again if key support's able to hold near 484.5. It does bear mentioning that the upside target that the market did reach was at a point of control number sitting at 507.5, and that number did also coincide with our sinusoidal wave coming in for a perfect time and price squaring out. We also had volatility-based resistance overhead, and so presumably it was going to be fairly difficult for this market to get past this 510 number, given the number of items that were all pointing towards potential resistance overhead. Again, we're looking for support to come in near 484, possibly as low as 480. And at 480, we do have our 180-degree price factor, and so support somewhere near this neighborhood is very possible. As the market continues to make its move, we'll look to see what the movement next week looks like to give us a better vantage point in terms of what it may do going forward. The US dollar is a bit in limbo as it continues to bounce between support and resistance. Most recently, it found resistance late last week near the 90.69 number. It dropped back down to potential support, coming in at about 89 and change. And the market simply continues to be range bound, in part because of what we're seeing going on with the European Union. The recent developments from the Italian government has recently elected an anti-European Union government, but it's still yet to put its leaders in place and to establish that government, as there is some haggling back and forth as far as a power struggle is concerned. If and when this new government's able to establish itself, we could see the further deterioration of the European Union, at which point we would see some weakness in the euro, giving some strength to the US dollar. If that's able to be avoided, then the opposite could very well happen, but until something concretely starts to develop, we're essentially looking at a range-bound US dollar going forward. From the perspective of the weekly chart, it is virtually unchanged, and we can see that it's been in a very tight sideways movement. If it breaks below the $88 mark prior to breaking above 91, we anticipate continued weakness. On the flip side, if it's able to break above 91 prior to breaking below 88 below, then we could see a minor bounce come in but long term we anticipate that potential weakness could very well be in the cards for the greenback. Thank you so much for joining us for our market update. Look forward to touching base with you again next time.